All right, good morning, everybody, and welcome to the Market Smith webinar. Today, we are going to go over investor psychology and keep it pretty basic for today. Quick introduction, my name is Arusha Pierce. I'm one of the product coaches here at Market Smith, and let's make sure we all have the webinar software functionality before we really get started. It's located in the top right-hand side of your computer, and whenever you have a question, just use this little question panel to type in your question, and we will make sure to answer it by the end of the presentation. And a quick disclaimer here, all of this should be taken as educational purposes only, and please don't take it as a buy or sell recommendation. And so when we talk about psychology, really what we're talking about are your emotions, right? So I'm sure most of you have been doing this for a little while, and you know that once you put some money on the line, it can get very emotional. And usually you will get extremely emotional at the wrong times. Maybe when you're not doing very well, you start getting upset and you don't want to give up and admit a mistake at that point. Or if you're doing really well and you're starting to make some good money, you start thinking that you're the cat's pajamas at this point, right? You think that you are the man at this point. So you want to be aware of that. Is it the cat's meow? So someone that was cat's pajamas, but no, I don't know. Someone correct me there. Maybe it's a cat's meow. But let's go over the emotions. And here are 3 ways that you want to use to control your emotions. And so these are the 3 we are going to cover over. And really, a lot of this should look familiar to you guys. The first one are the rules. And the more rules you have, the better you're going to be able to control your emotions, because the less thinking in real time at that point. The second one is just planning ahead, right? The more you do that thinking ahead of time when the markets are not open, the easier it will be to control your emotions. And then finally, being consistent at it, getting experience, always staying in touch with the market. That's always going to help too. So we'll go in more detail for all 3 of these. Now, with emotions, the ideal thing, the way we look at it, is the more rigid you are in the stock market, the better you're going to do. Okay, so ideally you want to act like a robot, right? As least amount of emotions as possible. But of course, the reality is you're always going to have the emotions. But as you get more experienced, in my opinion, you get better at controlling those emotions. So I think as you go through this, as you're trading and making your decisions, just try to become more aware of your emotions, okay, and when you're becoming emotional, because that can actually give you some clues. Maybe you should lighten up here, or maybe you should cut and run at this point, right? It's pretty incredible at how those emotions can help you out if you know to recognize them and kind of go opposite of what you want to do when you're feeling emotional. So let's go over the first one, and this is rules, and we're just going to start out with the classic rule here, the one that we preach here all the time: cutting losses quickly. And really, the bottom line is the sooner you learn that losses are a part of investing, the better off you're going to be. Okay, I wish that there was another way to do it, but every time you buy a stock, you are taking on risk. And so you have to be prepared for that situation that you could lose at it, which is why we control those losses, right? Now, the second one is the more you do this, I remember in the beginning when I got started at this, and I still remember those first few losses of mine. I dwelled on them all the time. All I thought about were those losses, and then I would kind of beat myself up too. Oh, how could I be so stupid at this? And what a stupid stock to buy, and all this kind of stuff, right? Don't dwell on them. Losses are part of the game, and they're never going to leave. And so the sooner you kind of get over the losses and accept that they're part of the game, the better off you're going to be, because what will happen is if you keep dwelling on them, you're mentally not in the right position to buy another stock when it's acting right. Then finally, and I think this is really appropriate for the market we are in right now, never allow one mistake to become 2. Okay, so if you're in a stock and you get shaken out of it, or if you get shaken out of it, right? And maybe rightfully so, you get shaken out of it, hits your stop loss or whatever. And now, instead of waiting for a proper buy point, you want to hop in near the lows and say, oh, this is going to probably rebound. I better get back in it after you see it go up for a couple of days. That's allowing one mistake becoming two. It's maybe you held on the first time for too long. That'll be your first mistake, right? So you were supposed to cut at 7%. You sell out at 15%. Now the stock bounces, and you hop in after it's run up, back up 5% from the lows, thinking it's because you were wrong to sell it. Now it sells off again, and now you're down another 10% on the stock. Okay, that's so easy. It's so easy for things like that to happen. Whenever I sell a stock, it's funny at how I keep watching it pretty closely. And a lot of times, the more you watch these stocks after they're in trouble, the more opportunity it is for you to do something unnecessary at that time. So that's a big one. That's something that I learned here in-house from Scott O'Neill, and it makes a lot of sense. Just don't allow that one mistake to become two. So here's the classic example right here, and the classic rule that we preach around here. Cutting losses, right? And our classic cutting losses is at 7-8%. And so here's Stratasys back earlier this year, back in March of 2014, and it broke out of this cup with handle at this point. And unfortunately, a few days later, it hits the loss box. Okay, so you can see here, pattern recognition picked up a cup with handle. It hit the blue area, which is ideally where you want to get into it, provided that there's some volume. And so you buy it, maybe bought it early in the day around 1:30. Now it's down, and a few days later, you're down to 120. You have to cut it at this point, right? So one rule that you always have to have is an exit strategy to the downside. Now you can use the 8% rule. We have this right here on the pattern recognition, and the key and really the psychological kind of mentality that you want to get into is, if I'm hitting that stop loss, I have to sell. Okay, you're not hesitating at that point. You're not going over the what ifs. Like, oh, what if it bounces back? You know what? I'm down 8%. If it bounces back up to 5%, I'll get out at that point. Now, you hit your rule. You have to follow those rules at that point. Or what's the point of having a rule, right? So you can't hesitate at this point. Now, in this example, it went down, right? And so this is really the reason why we do this, right? Because a lot of times they do go lower immediately, right? And so you sell out at 8% here. Now the stock is down another 10-15% from there. You're in the end, you're pretty happy at this point. So this is obviously the reason why we do this. Now, obviously, there are going to be some more frustrating scenarios. They're not all going to go down once we get out, even though we're hoping that they continue to go down after we get out, right? There are going to be a lot of them, and I'm sure a lot of people on this webinar probably can relate to this, where it's been a choppy, frustrating market in general, right? A lot of breakouts haven't worked. They're shaking us out, then they take off without us again. So let's go over that scenario. And so here's Salesforce back last year, back in May of 2013. And as you can see here, it put on this base on base on base. And officially, it was a stage 1C cup at this point, okay? And it forms this cup, breaks out of it, you try it, and now it comes back down again. So we know we have to hit the loss box. Okay, we have to protect ourselves at this point. It hit our rule, and so we have to sell, okay? Now, of course, in the end, you're November, this thing's way higher. Okay, so you sold out around here, and look at the stock right here. And so a lot of times, and it's easy to think that, I sold out at 8%, and in the end, the stock went higher. A lot of these stocks, this is why I should hold, because in the end, they always come back. I'm more patient, right? Or if you tell someone else that, I bought that Salesforce, you hit my stop loss, I sold out. If they're not following risk management or have any kind of plan in place, you're going to hear their comments probably where they say, why would you sell? It's a great company. And then a few months later, when it's up, it's like, see, that's why I hold. But let's try to dig into this a little bit more, okay? So now one kind of key here is that, remember, these rules are in place to prevent you from those portfolio destroying losses. Now, a number of losses that you take, they are going to go up without you. Okay. And it's very easy to like, oh, why did I sell at this point? It's not those half that go up without you. It's the other half that continue to go down, in a kind of a market that we're in right now, right? Where you're starting to see some of these stocks get in real trouble. And the big reason is it's just a numbers game, right? It's when you look at the percentages, it's much easier to recover from an 8% loss and a 25% loss. If you're down 8%, really on your next stock that you buy, you only really need to make another 8-9% to get back to even on that stock. If you're down 25%, the numbers are really against you at that time, right? You almost have to make around 40 to 50% the next stock. And of course, once you get even worse, when it's 50%, you have to get 100%, right? So those numbers get worse and worse, and it really goes against you at that time. And how often are we going to get 100% on any stock we buy? So a lot of this is just the percentages. We want to keep our losses small because it makes it much easier to recover from. And then finally, and this is another one with the emotions, right? The psychology. There isn't a rule out there that says you can't buy back again. Okay. And a lot of times we will buy these stocks again because, remember, we're usually looking at stocks that have huge potential in them. Fundamentally, they have a great story. They have the numbers. But the fundamentals and technicals don't always sync up. So we're looking when they sync up. So if it's not their time, it's not the stock's time to really run, it's not that time at that point, right? It doesn't necessarily mean it will never be the time. Some of these companies are so good that they'll just end up they'll eventually set up again in a 3-4 months. And now when everything lines up, when the market's there, when the stock reports a great earnings, has a great earnings report, and you have this massive breakout or whatever, now it's the time. Okay. So we can always buy these stocks back again. Now, if we dig into this a little bit further, so say you sell at the 8% here. So remember, we're going over the scenario of, okay, why even sell? Because this in the end went up higher. But you sell at 8% at this point. Now, who's to guarantee that you're going to hold through this whole thing? At the low of this, you're down 24%. So could you guarantee yourself that you would hold through this whole base at this time? What if this went down 30%, 40%? Right? That's how you get yourself into trouble. Now, I know for me personally, there's no way I would hold at this point. I would sell right at the lows. And I know that because I've tried it. Okay? It's amazing at how it just does enough to get you right at the bottom. And so if you say, you know what, I'm down 20%, it's probably around here where it should bounce, and then it bounces, you get a little bit of a bounce, and it goes back lower, then it gets you. Okay, so you're playing, that's where you let those emotions get to you too, right? So the worse it gets, the harder it is to recover from, and usually you will sell out right near the lows. So this is another huge reason why we cut it, to avoid that extreme emotions that we're going to get, because what will happen is when you're near the bottom, you're going to get extremely emotional and never think it's going to come back again, and you will sell out at that time. That's how bottoms are created. Everyone throws in the towel. You don't want to be in that situation. So now the good news is that eventually this stock set up again. The more you understand bases, the more you understand why bases are formed, because more people are getting shaken out. They're selling out the lows because they let their emotions get the best of them, right? They're not managing their psychology. Now, in the end, it forms a better base. It forms a handle at this point, and it breaks out on huge volume. And so this is where it's okay to get back into the stock again, right? The fundamentals are still there. And so maybe now the time is right. So remember, we're using the chart to help with the timing. We use the fundamentals to give us a reason, give us a list of stocks to focus on. A stock like a Salesforce, they've been doing some great things for years and years now. And they're one of the leaders, they are the leader in their market. So we know that. But you're not always going and buying it, because there are times where stocks are out of favor, where Salesforce could be out of favor too. And so there are no guarantees, because there could be another competitor that comes and takes them out. So here, you cut your losses, you wait for another time, and it gives you a chance to buy it back again. And here's not only breaking out of a cup with handle, RS line hitting a new high, and then take a look at that powerful breakout at this point. Now, in my opinion, if you really like the stock, like the story, all the fundamentals are lined up, and it's doing something technically like this, there's no hesitation at this point. You have to buy it at this point, right? Just don't let it get too extended. But this is the point where you're buying. This is your chance at this point, and then you see what happens, and you manage you have your risk management in place too, right? Just in case it doesn't work out. And here, if you bought it at this point, you end up, it goes up 24% from there, okay? So this is why, so say you tip that 7-8% loss, you end up getting 24% or around there, say 20%, so you make up for it at that time. So now let's go back, because there are a number of lessons. A lot of times when you do get shaken out or when the stock doesn't work, there are a lot of lessons to be learned from the stock that you bought, the base you bought out of. And so here are a few things. And, you know, I'll call these flaws, they're subtle flaws. They're not huge flaws, but there are a couple of things here. It wasn't a very convincing breakout. You see, kind of get above that pivot and kind of reversed. But the volume was kind of low at that point, as opposed to, let me just go back to this volume right here, 500% volume on the breakout, right? That's a massive breakout right there. Huge gap up, right? Now here, only 19% above average volume on the breakout. So which one's a little bit more convincing? Which one is telling you that funds are falling over themselves to buy more shares? They don't care at that time what price it is. We got to get more because they did something to excite Wall Street. Now, a couple of other things here. This, I wouldn't necessarily call this a flaw, but this is a cup with no handle, and it's straight up from the bottom. Now, the problem with the cups with no handles are if it doesn't form a handle before breaking out, a lot of times it forms a handle afterwards. And sometimes it can get that momentum going and cause the stock to fall apart at that point. So cup without handles, they're always very tricky. I really don't. I always hesitate at buying those because they are a little bit harder at that point. So if I'm going to try it, I better get that volume at that time. And so really, looking back at it, there are plenty of lessons here. And in my opinion, you probably should have held off on buying it, even though it is a great company at this time, right? Because they didn't have the technicals. Now, sometimes these can work. There are plenty of stocks that have done things like this where I've passed on and they ended up working. And that's okay, right? You have to kind of stick with what works for you. And once again, losses and mistakes are great opportunities to learn. And that's another kind of psychological thing there. I think the more comfortable you get at looking at your mistakes and admitting them and analyzing them, the better off you're going to be. That's very tough. But get over that hump because that's where you can really learn, and that's how you become better at this. Now let's go over the second one on controlling your emotions, controlling your psychology. And that's really planning, like doing the work ahead of time. The less thinking you do during the more thinking you do outside of the market, the more planning you do, the better off you're going to be because the less thinking you have to do when something's happening. And so you've always seen this phrase, right? Plan your trade, trade your plan. And there might not be a more perfect phrase in investing than this one, in my opinion. And so here is an example of planning your trade. So here's a stock in a really nice uptrend. Broke out of this cup with the handle at this point, goes up 20%, and then rests, right? So a lot of times you might miss out on this run, but you say, hey, the stock went on a great run. Here it is setting up this flat base at this point. This is the time where you want to be doing your research. This is the time where you want to be planning. Okay, you want to do all the work while it's building the base to figure out whether the stock is right for you or not, to figure out those fundamentals and whether it's a potential game changer. Okay, you're not waiting for the breakout to do that work. You want to do it ahead of time. Okay, you want to do all that planning ahead of time so when it actually does break out, there's no thinking at that time. You've already done all your thinking. So here's an example of something we did in-house here on the stock. So this is NXPI a couple of years ago, and here was just a quick snapshot. Okay, what do they do? Right? Here are all the little things they do. You know, NFC, now we're all hearing about near field communications and all that stuff. All about the phones that are coming out, right? And they're being able to pay from your phones, right? Well, these guys are a big player in that industry. And so the more you kind of do the research, the more you can understand that, hey, wait a minute, if this kind of comes to fruition, we have a chance here. You know, this stock could do really well. They could just be in demand if they are the dominant player in the market. And so I recommend that for some of those stocks that have those huge earnings, have those huge sales, and maybe that big story, to take some time and try to kind of lay out your thoughts and say, okay, do these guys really, are they game changers? Now, when you're looking at it also technically, so say you take a look at the stock, you're like, hey, you know, they have a great story. Now, really, part of that thinking ahead of time, you really want to just kind of figure out every aspect of the trade. Okay, so you want to think about, okay, what could the buy point here? If this turns out to be a flat base, and it might not, you know, in reality, this could sell off again, go down lower, and maybe create a larger cup or something, right? But at this point, pattern recognition is drawing at a flat base. It's getting support off of 50. And so you want to think that, you want to start thinking that, hey, you know what, this could be a week or two away from breaking out. Okay, so if it broke out of the flat base, what's the buy point? Well, the pivot is 39.46, add 10 cents to it. So we get the buy point of 39.56. So you write that down. Now, how many shares do you want to buy? Okay, I want to put 100 shares in this. Okay, what's my exit strategy? Right, so we're always talking about exit strategy to the downside. You want to think about both sides. How am I going to get out the stock? Okay, so if it goes up 20%, this is where the price would be. Okay, 47.35. If it's down 7%, here's the price. So you guys see how putting all these numbers, putting all this ahead of time gives you a structure on where you're going to get out, kind of reduces those emotions, right? Puts you, psychologically puts you in the right frame of mind. You're doing all that thinking ahead. You don't have to think in real time when the stock's going all over the place. Now, when it breaks out, I want at least 50% volume on the breakout. Now, generally for me, I'm looking for over 100%. In especially choppier markets, I generally look over 100% if I'm going to buy the breakout. And the reason is when I went back and looked at a lot of my trades, the ones that I ended up doing pretty well at, they had those huge breakouts. So I try to refine it at that point. And then, oh, by the way, earnings day is coming on this date. Okay, so you want to be thinking about those. Okay, what's another catalyst? Maybe it's the earnings date that propels this higher, right? Gives it that power to break out on a huge volume. And a lot of times that's what happens. Okay, or maybe it's the earnings date. What if it breaks out right before the earnings, a few days before, and you go and jump in and you don't realize it's reporting earnings in a few days, and now it gaps down on you. You have to be careful of that. I've done that, where I bought a nice breakout, and all of a sudden, a few days later, it's gapping down on me. It's like, wait, what happened here? Oh my God, they had reported earnings. Okay, so the more you do planning ahead of time, the better off you're going to be. And then, of course, when it does break out on huge volume, there's really no thinking at this time. You know exactly, okay, I'm going to buy 100 shares at this price, and it has the volume, and now I know exactly where to get out of. So you guys see how that's reducing your emotions, how it's managing your psychology at that time. You're doing a lot less thinking, especially when the market's going all over the place. And so, yeah, this is NXPI. This is back on October 25th of last year, almost exactly a year ago. They reported earnings, bam. And take a look at that. Nice breakout out of that, the flat base. And I mean, I liked how it undercut the low at that flat. That's brutal. Undercut the low and then comes right back up. And then you have that huge skyscraper volume. So there were some funds starting to get into the stock. And isn't that interesting, right? A year before you start hearing about how maybe people are going to start paying with their phones. You start seeing some of these funds really starting to place a larger bets on the stock. And this is a snapshot I took five months ago, and it was up here. And so I went up a little bit further, but here you go, 50% run. Imagine just catching a little bit of that, right? 15, 20% of that. And so let's go over the final one here about ways to just control your emotions. And in my opinion, I think consistency. I think this is a really big point. It took me years to realize this one. Just being consistent at your routine. Okay, so consistent at the routine, consistent on your position sizes, consistent at your entry points. And really, the more consistent you are, the more work you do, in the end, you're going to get out what you put in. And all of these little kind of tidbits that you're doing, this extra work, it just helps you manage your psychology. It helps you manage your emotions because you have much more of a plan in place at that time. You've already done a lot of the preparation, right? All the exit strategies. And so now you're prepared for any kind of scenario. And so generally when I talk to people on the phone, this is what I recommend. If you have more time on your weekend, try to do most of the work on the weekend. Okay, so a couple hours on the weekend, go through stocks and come up with that game plan of what you want to do during that week. Now, I recommend scanning for stocks on a technical basis first. Once you start getting into this, it's going to enable you to go through a lot of stocks quicker. So I'll show some examples of that. And it will help you focus on the stocks that are actionable. If they're not building a base or they're not anywhere near a buy point, your time is probably better spent looking at other stocks, right? If you have more time, then you can always go back and start looking for larger stories. But if they're not ready to go, they're not ready to go. And I think this is another really nice thing. If you get consistent at a routine, it's going to help you catch into your rotation. And so I'll show you some examples of that too. And in my opinion, the way to stay on top of the stock market, just look at a lot of stocks. And being consistent at it, it's going to help you do that. It's not going to be an overwhelming routine if you're consistent at it. If you just do a little bit of more work on the weekends, you don't have to do as much during the weekdays. So let's go over some examples of how to scan for stocks on a technical basis. And so if I'm pulling up any list, if I'm pulling up the Grow 250, and so I will go through the Grow 250 on Saturdays. And the first thing that I'm looking at is the price and volume action, okay? So I'm looking to see if the stock is setting up, and I'm looking at the volume. So it's purely technical at this point. So really, my question that I ask myself here when I'm looking at the stock is this stock setting up or not? If it is, I'm going to throw it on a watch list. If it's not, I'm going to just move on. Okay, so we can see here that this stock is setting up. It actually broke out of a base, it got support off the 10-week, and it's right in that blue area. So if it's not on your watch list already, you want to add it here. Okay, if you already know a lot of things, maybe you're considering buying it at this point. But at least you're adding it to the watch list. So up in the MarketSmith, we have a little add to watch list. You can just add it right up there. And then you hit the space bar and move on to the next stock. Okay, you're not looking on the left-hand side here for the fundamentals at this point. Okay, you're just really going through a larger list and picking out the stocks that are actionable. So you go to next stock and say, okay, then this one looks like it's setting up again too. Okay, let's throw this in the watch list. And let's go to the next stock. Oh, look at this stock. Well, this stock doesn't look very actionable at this point, right? It's below the 10-week, not setting up anything. Okay, nothing to do with this stock at this point. Let's just go to the next stock. Okay, so that's pretty much what I'll do my first pass through in any list. I'm just going yes, no, yes, 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 no, and throwing stocks into a ready list. Now, there are a couple things that are nice about this. First, there are going to be certain weeks where you'll notice that you're adding a ton of stocks to the watch list. There are other times where you'll realize that you're adding nothing to it. So you're already getting a nice feel for the market, especially when you are in a bad market. Okay, so I find this routine even more useful in a bad market. If you're in a bad market and all of a sudden you start seeing in another month or so, after a pretty bad correction, you start seeing a bunch of stocks setting up, hey, that's telling you something. It's telling you that there are a number of leading stocks that are setting up and they're just waiting for the market to come around. I mean, that's vital information giving you a heads up that you should start preparing, doing the research, and preparing for maybe a fall-through day coming soon. Okay, so this is really giving you an idea of the underlying strength or weakness in the market. So I definitely encourage all of you to start playing around with this to see if it works for you. Now, with this consistent routine, not only will you develop a feel for the market, you're also going to get an idea about rotation, industry rotation. And so this is a snapshot that we took back in March. And you can see here internet content at this point. This was during the Scott O'Neill webinar, the Master Market webinar. And so they were talking about here how the internet content group had dropped from industry group rank of 6 down to 16. Okay, so it was a little bit of a drop at this point in 1 month. Okay, so they just noted that. Okay, maybe something's going on with the market. Now, when you looked at some of the underlying stocks at this point, how were they looking at that time, right? So here's SoFun, and it's breaking the 50-day. Doesn't look very good at this time, right? Doesn't look very actionable. In fact, it looks the other way. It looks like it's in trouble a little bit. Here's another one, Qihoo, selling off, breaking the 50-day on big volume. Not looking very good at this time. And also Google, breaking the 50-day. So what is that telling you immediately? Hey, some of these stocks, they're in a little bit of trouble here. Now, they're probably not going to zero, but they're probably need a bit of a rest. Someone's trying to get out of them. And in the end, this is a snapshot in May. The whole internet content group went down to 151 in 2 months. So this is some of the reasons why we look at a lot of stocks, why we're looking on a technical basis first, because when you see things like this, it can give you a heads up that, hey, maybe this whole industry group is in trouble. And the only way you get that feedback is by looking at a lot of stocks. The only way you're able to do that is by having consistent routine, right? And naturally, you're getting more prepared and you're getting less emotional at that point. So that's all I wanted to talk about today. So let's go put it into practice. And so I definitely encourage you to keep working on your own psychology and take some of these, and hopefully they'll help you manage your psychology, because the bottom line is that, in my opinion, 90% of it is just managing yourself, right? The rules are there. We know what to do, right? We know what to do in a good market. We know what to do in a bad market. We know when to get in and when to get out. Now you got to come up with some rules to manage yourself, because that's the biggest thing. All these things we talk about, they work. Then when they don't work, that means that the market's not there. When they do work, it means everything's lining up, right? So they will get you in at the right times, get you out at the right times. But you have to come up with some rules to manage yourself, because it's amazing at how easy it is to screw up those basic rules. So come up with some rules and recognize as you're going through, as you're trading, when you're getting emotional, because that is a pretty fascinating thing. It's especially fascinating when things are going well. At least for me. In fact, I ended up writing a rule for myself when I started getting too excited about a stock and doing too well in the stock. I started writing a rule for myself to start taking some off the table. If I started getting a little too giddy, take some off. And the way that happened is when I look back and notice in the past where I was getting giddy, a lot of times the stock would end up selling off pretty heavily, and I'd end up round tripping some of these stocks. So I force myself to take some off when they're working too well. And trust me, that's the hardest thing for me to do. So the last thing I want to do is when something's working well, start taking a little bit off. And then finally, hopefully that this is helpful. I would recommend playing around with some of these, incorporate it in your routine, especially the consistency part, doing more work on the weekends. That will help you stay on top of the market. So I'll hang around for a couple of minutes here for a little Q&A, and I'll put up the contact information while we take a look at the questions. All right, we got an interesting question here from David. All right, since we know that psychology has a big part of trading, any kind of exercises that do, I guess you can look in just calming your mind, right? If you look at meditation, exercise, All of those things can help. I think the biggest thing is just becoming more aware of your emotions. That's the exercise I've done. And I've just been doing that for years. Is just becoming more aware when you start getting upset, when you start getting too happy. And it's not, you can practice that outside of trading too, right? Just in normal life, when you start just getting too emotional, the more aware you are of those emotions, the better you're going to be able to control them. I thought that's a great question. But yeah, meditation, all these kind of yoga, right? I mean, that I think that's my ideal goals, yoga. I want to one day do yoga. Of course, I'm not flexible at all, but I think that would help me. But yeah, so I think keep working on it. There are plenty of books on bringing your mind, controlling your mind, and all that kind of stuff. But that's a great question. You can never do enough to manage yourself. Okay, we got a question here from Nick here. Taking in consideration the overall market conditions with the CRM example, yeah, you're taking taking into account everything, right? So, for instance, these last few weeks, the market had a lot of distribution. The market was in a correction. Now, I wasn't. I still had positions on a few weeks ago, right? A couple of weeks ago, things like that. I still had positions, and really, I was probably forced out only on Friday, but. I had some, but I was forced to lighten up because of the market, because it was getting obviously more treacherous, but I still had some around the 50 because they're kind of hanging in there still. But I had stops in place at that point. And so some people are asking about stops and all that kind of stuff. I would recommend putting some stops in place. That's how I do it. I'll have some stops in place for some of my shares, not all of them. But I was for some and the reason why I did this is to control myself, right? Because there are times where I wouldn't sell immediately, right? I might sell if it goes down a little bit more, but I'd kind of hang around a little bit too long sometimes. So I will, anytime I make a trade, I figure out my exit strategy on the downside, and I'll place some stops in place, just so it takes me out of some and kind of wakes me up. Hey, idiot, the stock is coming down. Okay, so I do things like that. That's how I manage my own psychology. Oh, okay, Phil, that's a good question about the price and volume. How do you handle volume at the breakout? Now, so this is what I'll do, and yeah, keep an eye on this. With the volume's projected volume, and so generally, if you're going to get a powerful breakout on huge volume, a lot of times in the morning, so after that first 30, 40 minutes, that's when we'll start getting volume into market, Smith. Uh, if it's on a breakout, what you want to see, so say for me, I mentioned one of my rules is, for the most part, I want to buy stocks that have over 100% volume at the breakout. In the morning, it's usually, since it's projected, usually it's over 500% in that first 30, 40 minutes. And then it will taper off down to 100%. So I'm looking in that very morning, 500%, a lot of times 1,000%, more than that. That gives me an idea that, okay, there's massive volume coming in here. And so it should taper off to 100% or so by the end of the day. So that's how I do it. I'm not always buying in the morning, but I'm going to pay very close attention and say, okay, this stock is getting really good volume in it. Let's watch it throughout the day and then figure out when to buy it. Oh, Logan, that's a very good question. How do you handle a string of consistent losses mentally? That is very difficult. And I don't know if I handle it very well. I don't know if there are going to come points where you have to pick yourself off the ground. It's very difficult. And we all go through that. There have been a number of times where I wanted to throw in the flag. The market just got too challenging. Right, and it would seem like every stock I bought I would get stopped out. I was wrong consistently at it, and so I guess the way that I ended up handling it is I would just stop trading. If I start hitting like five in a row, that's telling you some feedback at that point that maybe something's wrong here with the market, or maybe it's something wrong with you at that point, right? Maybe you're just out of sync with the market. And so a lot of times what I'll do is I'll get out of I'll just get out at that point and kind of take a step back and maybe take a few days off and try to say, okay, try to look at it a little bit more objectively. So that's how I'll handle it. I will definitely start noticing if I start going on a string of losses. It'll be like a little alert that goes off on it. And same thing, if I'm consistently right on some stocks, that's also going to be alert too. That's okay. Maybe the market's getting stronger, or maybe the market's getting a little too out of hand too. Okay, so those are things that you pay attention to. I don't know if I handle it well or not, but the biggest thing is to keep hanging around. It's very hard to pick yourself off the ground. There have been some really tough times where I didn't think I was going to come back at it. This is hard, right? Though the ones who end up getting better and better at this are the ones who just hang around longer. And so that's the thing. That's the biggest thing, I think, and that comes down to psychology at that point too. The more you can control it, obviously, you're going to do better at. But that getting mentally prepared, really mentally preparing it for yourself, saying, hey, I want to stay around for the long haul, right? And having those expectations, realistically, taking this more as a challenge and learning too, right? So the way I look at it is, those first few years, you kind of have that's where you're going to really have to pick yourself off the ground, because you're going to be making those big mistakes. So not only the reason why we all get into this, obviously, is to compound our accounts, right? To make money, grow our accounts. But what people don't realize, especially in those first few years, is that you're compounding your knowledge too. Now, after a few years, you really start realizing, because now you really pick it up. But the more you hang around, the more you study this, the more you're compounding your knowledge at it. And so that is a huge part. And so the more experience you get, the more you can kind of reflect back on it and then figure out and recognize it maybe a little bit earlier the next time around. But I think just looking at this in the right way, that is not a get rich quick kind of method or anything like that. It's, hey, we're going to be around here for a while. We're going to need money. We need to be in this for a long haul. So the more I do about this, the better I'm going to be able to be there when the markets are right, and more importantly, protect myself when the markets are getting dangerous, right? So that's how I look at it. And then I think after a few years, once you really get that going, it becomes more and more fun, because now you're more right, and then you're able to sidestep some of the pitfalls a little bit better. Oh, and Anish has a good a good suggestion with the losses. If you go through a string of losses, then you start trading a little bit smaller each time after that, and continue to get smaller until you start getting right and start breaking the momentum. I think that's not a bad idea. There are times where I'll do a very small trades just to get into the market, and a lot of times that will break it. So yeah, I do like that, Anish. Okay, if the market forces you out and the technicals on the stock look good, market's still in correction, do you buy or wait? That depends. It depends on how well you're doing on the year, if you're up on the stock. Now, if you're up on the stock like 50% and it's coming back to the 50-day, and we're in a market in correction, and that's the only position you have, and so really you're only in like 20% of your account, I don't see anything necessarily wrong with you kind of giving a little bit more room and saying, you know what, I'm already up a bunch on it. Let me see if I can hang in there and see if it holds. But you have your stops in place, and you can do that. In my opinion, if you're up on the year and you're up a decent amount of stuff, you've earned the right to kind of give it a little bit more leeway. Now, if you're down on the year, down on some of those stocks, you've lost that right. You have to protect yourself at that point. You just don't want it to get worse and worse. Let's see. The near pivot list in the Growth 250, yeah, that should. It's usually within 5% of the pivot. Once it gets around there, yes, that's where it's going to start picking it up. On that, I'm pretty sure that it's around 5%. It might get it might have a little bit more leeway than that, but it's around there. Okay, that looks like that's all. I've gone way over time here, but thank you for joining us. There's the contact information, and please feel free. Okay, we'll see you next week. Well, definitely contact us if you have any more questions.